The following segment is a paid commercial program by Heritage Bank, member FDIC. It's time for Ask the Expert on News Talk 1340 and 96.3 FM, KWLM.
Yeah, thanks for joining us once again today. Chris Fra from Heritage Bank joining us this morning on Ask the Expert. Chris, good morning.
Good morning, Todd.
Thanks for coming in. I appreciate it.
My pleasure.
I see John at games with some frequency, certainly. And, of course, we've worked together in the past and so forth. So
Yep, the sports season is wrapping up for the winter.
Yeah.
But, he always enjoys those.
Yeah, he's a site administrator, assistant AD at Willmar High School. Now, I got to know him, of course, many years ago. He's one of the first people I knew when I came to Willmar 30 years ago.
That's about right.
He was coaching Ridgewater football then, and so I got to know him pretty quickly. Hey, so we want to talk construction loans today. And what's kind of the process if you're thinking about doing that?
Okay, well, it's a good topic because the spring is coming and everybody that is looking at construction is already, well, I better get going. And that's what I would say is start early. I mean, if you want to even build this spring, it would have been nice to start thinking about it last winter because you are going to want to talk to your contractors and get your house plans set. Also get a list of costs, like a sworn construction statement. So your plans and your specs from your builder, and then talk to your lender and see what the process is for the lending process. So in essence, it's a little bit different than just purchasing a home. So you're going to have two loans rather than just one to purchase because you're going to need to construct that home. So we have a construction loan, which is typically a line of credit. So you are, let's just say, for example, you get a $400,000 construction loan. Then you are, whenever you need to make payments to the contractor, we advance on that construction loan and we pay the contractor. So the $400,000 isn't outstanding for the entire time. So you pay interest only monthly on the amount outstanding. So your payments on your construction loan are going to be lower in the beginning than they are at the very end. Typically, banks write construction loans for 1 year, and we're hoping that you'll be done with your project in that 1 year time period. If you have to go over, we usually do a 3-month extension, but we really want you to have that project done, and then that comes to the permanent loan. We have the second loan, which is the permanent loan, which refinances or pays off the construction loan. And that is where, kind of like on your purchase loans, where you have your 30-year fixed rate loan that you're paying back monthly. So, but what we do, honestly, is when you come in, we want to first pre-approve you for the permanent loan because no one wants an everlasting construction loan on their books. We don't want it. You don't want it. You're going to want to get to the point where you're starting to pay that down. So we approve you for the permanent loan. And then once we do that, then we say, okay, we're willing to give the construction loan for you to get this project done. The difference on a construction loan given a purchase is you do not know what your property is worth. If you're purchasing a $400,000 home, you have a purchase agreement that says $400,000. But when you're constructing a home, what is that end product worth? So we, at that time, get the plans and the specs from your contractor, and wherever your land is, we send an appraiser out to your land, and they take the plans and specs, and they appraise the home as if it was done. There is our unknown value that comes back to us. So once we have you approved financially, now what we need to know is what is the value of this home when it's done. If it's worth $400,000, banks do not lend $400,000 against a $400,000 project, so we take a percentage of that, and then we see if that meets the amount that you need to be able to build that project. And if it doesn't, do you have the assets or the checking and the savings and to be able to finish the project? So between the bank and yourself, do we have that? So that's where the difference comes in from purchasing to construction loans. Construction loans are involved and they take a lot of time. They can be agonizing at times. Many times when people get done with the construction process, they'll say, I'm not going to do this again. But if we talk early and develop the plan, I think we can do this pretty stress-free.
Yeah, it's interesting that you basically have a pot of money set aside that people draw off of as money is needed to fund the construction project. It's really a great way to save yourself interest on the back end of that loan.
Right. And, if you have money to put in it right away, you can use your money first, so you're not paying interest on the construction loan at the time. So, but many people, I just want people to understand that there will be cost overruns. And that it will not go as fast as you think it will.
Just be prepared for those two things.
Be prepared for those things so that it's not a surprise to you. I always try and tell my borrowers that. So the rule of thumb is plan on 20% cost overruns. It's not even on just one thing. It's just over the overall project. There are many things like excavating and the depth of your well and what type of septic you're going to put in that you don't sometimes know until you start getting into the project. So those things have variables that you can't control. There's going to be some things that you decide midway through the project that you're saying, you know what, I really want to do this now. And it costs a little bit more money at this time, but I want to do this now rather than try and do it 5 years from now. So you're going to have some very calculated cost overruns and some that you're not going to be expecting. The rule of thumb, 20%. So have that in mind. When we are looking at construction borrowers, we are looking for our strong borrowers, ones that have reserves, ones that if we do have cost overruns, even more than 20%, that we have a way to pay for those so that we can get you into your permanent loan and get that project done.
Your first-time home buyer isn't typically building from the ground up anyway,
Correct. That is, and a lot of times we'll have a first-time home buyer come in and we'll for sure consider it. I mean, you just don't know, and maybe there's parents that are willing to help and so forth. So we look at all of that, but maybe they're one house away from doing their construction build. Maybe not, but we take a look at the whole picture. And sometimes what we can do is say, you know what, let's get you in your first home and you start looking for some land. If you ultimately want to build, where do you want to build? And maybe purchase that land first and pay on that as you go. And then 5 years from now, you can come in and you can say, I have my land, I'm going to sell my house, I have the equity in the house sale. And any equity you have in your land is considered down payment on your project for your new construction loan. So let's say that you own a $75,000 lot and you own it free and clear. Well, you can come right in, and that when the appraiser goes out there, he's appraising your land and your project on top of it. Many people ask that question. Is my land also included in my appraisal? Yes, it is. So now if you already own that land, you purchased it for $75,000 5 years ago, maybe it's worth $100,000 now. That is pure down payment into your project, some money that you don't have to come up with. It provides equity in our project. So I always think and love when someone comes to the table and they already have the land purchased. And if it's free and clear, that's the best. But if it's even if it's partially paid, that is giving you some equity in the project. The other thing that some people come to the table with is that a grandparent or parents have 40 acres and they're going to gift 10 acres of land to their son or daughter. That also provides equity in the project and less down payment that you need to bring in yourself.
It's all about location anyway, right? I mean, it's not all about it. You're building your dream home, of course. But the location is such a big part of it. I would think that would be kind of a natural progression. But you probably have people come to you and say, I want to build. I'm not sure where. What's the process? So then you walk them through it and say, well, start finding the land. We'll work on So how long does it take from the first moment they walk into your office, say, we want to build our dream home somewhere? How long does it take before they can actually start building?
Well, that's just it. It's like I have a lot of people coming in now at this time and saying we need to start early April. Well, we're mid-March already. So that's...
Good luck with that.
Yes. It's, to me as a lender, I would like to have 6 to 8 weeks to be able to do this, because most of the time when people come, there's still things that we're going to need. Maybe they don't have all their plans done, or they don't have the specs done, and they haven't talked to the contractor yet. At that point, we're going to need to get all that information. So if we can start early, I had people call me last fall to say they want to build in the spring. I love that, because then we can get a plan of attack right off the bat so that we are ready in the spring. So if you're coming in March, I would say that the earliest you're going to be able to start is the end of April into May. But talk to your builder and talk to your lender and get prepared. And just know that it might take 6 to 8 weeks before you can start. The other thing in the state of Minnesota, we have title work done on the property that you're going to be building on, and the state of Minnesota has a law. It protects and protects you is that you do not start any work on that land until the construction loan is in place. That mortgage puts us in place. Heritage Bank, your bank, in first position, versus if you start work, now you open it up that contractors can have first position. If something wasn't paid, they can file a lien on your property and so forth. So that is something that, the contractors all know it, but they're itching to get started. And so they want that construction loan recorded at the county level so they can get started. So, and we always talk to the contractors, and they know it too. Don't start. Yeah. This puts us in a position that we don't want to be in. We want you to be able to start as soon as our construction loan is recorded at the county.
Yeah. You've explained some of the differences already, but is there multiple closings then involved since you have the construction loan and then you shift over to a regular mortgage?
Yes. At Heritage, we do 2 closings. So we do the construction loan closing, and at that point, you'll pay some closing costs, and that appraisal that we talked about earlier in this is good for 12 months. 1 year. If we surpass that 1 year, we will have to have a whole new appraisal done. And now we're subject to what the value is at that point, too. That may be different than what it was the first time we did it. So we like to get that project done within that 1 year so that we're dealing with the same value. That appraiser that went out initially, when you're done with your project, they are going to go out again and just do a final inspection. It's not a whole new appraisal cost, but they just ensure to the bank that you did and put up what you said you were going to put on that property, and that it is worth, they recertify the value, that it is worth what they said it was going to be 9 months prior. So that cost is not a duplicate if you can get things done within 1 year. Title companies here are very good to work with us and not have a lot of duplicate fees, or they lessen their fees. But you should plan on, just by virtue of doing new construction, is that you are going to have some duplicate closing costs because you do, in fact, have 2 loans.
I see.
So consider it a cost of doing construction that you will have some of that.
Also, inspections come when you're buying a home, although we had a crazy period where there were no inspections. But they do now. Even in new construction, do you have to have an inspection for it?
And the inspection really is what we do is, as lenders, is we go out when you're asking for advances on your construction line. We want to make sure that there is actually progress happening on there, that we're just not advancing for nothing. But we do control all our advances through the title company. So we go ahead and we'll go out to the property and we'll take a look and make sure that the things that we're paying for are already done.
Yeah.
And we work closely with the contractor.
Sure.
All of us work pretty closely together. The contractor, the title company, you as the lender, you as the borrowers, and us as the lender.
Yeah.
So we know what's going on.
Are you able to lock loan rates even on construction loans similar to a?
That's a good question. That is on the construction loan, your rate is going to be fixed. It's going to be fixed during that year's time period. So, and that is one rate. But as far as the permanent loan, we are not going to look at locking that in until you're probably almost done with your project. And the reason being is when you lock in on an interest rate, you are locking in for a period of time. So if we do a 60-day lock for you, we need to close by that 60th day. And when we're dealing with the contractors, weather can cause a lot of things. This project has to be complete. We cannot close and still have work to do on the property. We need to pay off that construction loan in full, and the property needs to be completed, and the appraiser needs to do the final inspection. So I always tell my borrowers, once they're completed, once the house is complete, you can move in, you can do all that, but we may not close on that permanent loan for 3 to 4 weeks after that. That project is complete. Yeah. And that's when we really look at the interest rates and start to look at locking in.
Sure. Let's say you just want to remodel your house and not build a new construction. Can you use a construction loan for that?
Yep. And so I would call your lender on that. If you have a $400,000 home and you don't owe anything against it, and you want to do a $100,000 remodel, then at that point we would not do a construction loan. We would just we'd just take out a mortgage on your existing home before you even start construction, because you have the equity to do that. So we would just base it on that. But let's just say that you own a $200,000 home and you have a $100,000 loan outstanding, but you want to do a $200,000 construction project. Well, you don't have enough equity in your home at that point. So what we do is what's called an existing construction loan. And so at that time, a lot of the times we may pay off your first mortgage with the construction loan and then have a line of credit on top of that, and then get your improvements done and then pay it off with one permanent loan after that. The question many people will have at this point is if you did any sort of refinancing for 4 or 5 years ago, your first mortgage rate is probably in the 2s and 3%. And so they're going to say, why in the world am I going to be paying this off to do another? And we'll look at both options. If you have $100,000 left at 3% and you're going to do a $150,000 project, well, maybe it makes more sense to combine them and have a medium interest rate rather than have one high interest rate and one low interest rate. So we'll look and give you options on that.
Chris, give us a phone number.
You can reach Chris Fra at Heritage Bank at 320-214-5507.
HeritageBankNA.com is their website. Ask the expert, Chris Fra. She is a mortgage loan originator from Heritage Bank. Thanks for coming in.
Thanks, Todd.
You bet. Chris Fra joining us this morning on Ask the Expert.